We make decisions about money and debt every day, but do you really know what happens next? 15 quick scenarios, 3 choices. Let's see how sharp you are. Round 1. You use your credit card's cash advance feature to withdraw $500 from an ATM. What begins immediately for that $500 withdrawal? A. Interest accrual, often at a separate higher rate. B. A 6-month grace period. Or C. A 24-hour hold before funds are added to your balance. The answer is A. Cash advances typically do not have a grace period and begin accruing interest from the day of the transaction. All right, you have $10,000 in debt across 3 credit cards. You take out a $10,000 personal loan and use it to pay off all 3 cards completely. You keep the card accounts open with 0 balances. What happens to your credit utilization ratio after the payments are reported? Is it A, the ratio increases because of the new loan, B, the ratio is unchanged because the total debt amount is the same, or C, the ratio decreases because the card balances are now 0? The answer is C. The ratio decreases because utilization only measures revolving balances, not installment loans. Next one. Your credit card payment is due on the 15th, but you submit the full payment on the 16th. How does the timing of your payment change what is added to your account? A. A late fee is added to your balance. B. Your credit limit is automatically reduced. Or C. Your interest rate is permanently increased. The answer is A. Paying after the due date, even by 1 day, contractually triggers a late fee to be charged to your account. Pay attention. You need to make a $5,000 purchase and use a new credit card offering 0% APR on purchases for 12 months. You make only minimum payments for the first year. At the end of the 12 months, you still have a $4,000 balance. What happens to the remaining $4,000 in month 13? A. The full 12 months of deferred interest is added to the balance. B. The balance is forgiven as part of the promotion. Or C. It begins to accrue interest at the card's standard purchase APR. The answer is C. It begins to accrue interest at the card's standard purchase APR. Here's a good one. You make only the minimum required payment on your $2,000 credit card balance. What happens to the portion of your balance not covered by the minimum payment? A. It is moved to the next billing cycle interest-free. B. It is charged interest based on the card's APR. Or C. It is converted into a zero-interest promotional balance. The answer is B. It is charged interest based on the card's APR. Okay, listen. You take out a $15,000 personal loan that is secured by your car's title. After a year, you lose your job and are unable to make any more payments, and the loan goes into default. What action does the lender now have a contractual right to take? A. Seize the car you used as collateral. B. Garnish your wages without a court order. Or C. Place a lien on your home. The answer is A. A secured loan gives the lender a right to the specified collateral, and defaulting allows them to take possession of the asset. Quick one. Your credit card statement is generated on the 5th with a $500 balance and a due date of the 28th. You pay the full $500 balance on the 25th. What happens to the interest for that billing cycle's purchases? A. A credit for the interest is applied on your next statement. B. Interest is charged on the average daily balance from the 5th to the 25th. Or C. No interest is charged. The answer is C. Paying the statement balance in full before the due date satisfies the terms of the grace period, avoiding interest charges. All right, round 8. You complete and submit an application for a personal loan from a bank. What happens to your credit report as a direct result of the bank's decision process? A. Your oldest account's age is reset to 0. B. A hard inquiry is added. Or C. Your credit score is frozen for 30 days. The answer is B. When a lender pulls your credit history to make a lending decision, a hard inquiry is recorded on your credit report. Let's see. You have a $5,000 balance on a variable rate credit card and a separate $5,000 balance on a fixed rate personal loan. The central bank then raises the benchmark interest rate. How does this action affect the interest rates on your two debts? A. Both rates increase. B. Only the credit card's rate increases. Or C. Only the personal loan's rate increases. The answer is B. The credit card's rate is variable and moves with the benchmark, while the personal loan's fixed rate does not change. This one's interesting. You pay off your oldest credit card with a $10,000 limit and immediately call to close the account. What happens to your total available credit? A. It increases by $10,000. B. It remains unchanged. Or C. It decreases by $10,000. The answer is C. Closing a credit account removes its credit limit from your total available credit across all accounts. All right, next. You have a $3,000 balance on a credit card with a high interest rate. You transfer this entire balance to a new card that charges a 3% balance transfer fee. What is the starting balance on the new card? A. $3,090, B. $3,000, or C. $2,910. The answer is A. The balance transfer fee is calculated on the transferred amount and is added directly to the new card's principal balance. Stay with me. You have a 5-year, $20,000 personal loan with no prepayment penalty. 2 years into the loan, you pay off the entire remaining balance in one lump sum. What happens to the interest that was scheduled to be charged over the final 3 years? A. It is waived and not charged. B. It is charged immediately in full. Or C. It is converted into a loan closing fee. The answer is A. Paying the principal to 0 on a simple interest loan stops any future interest charges. This one's tricky. You make a large purchase that brings your credit card balance to $950 on a card with a $1,000 limit. What happens to your credit utilization ratio for that card? A. The ratio is frozen for that billing cycle. B. The ratio is calculated as 95%. Or C. The ratio is reported as 0 until the balance is paid. The answer is B. The utilization ratio is the current balance divided by the total credit limit. Okay, next one. You co-sign a $25,000 personal loan for a family member. They make payments for 6 months, then stop paying entirely. What happens to your legal obligation for the debt? A. You are obligated to pay only the interest. B. You are fully and equally responsible for the entire remaining balance. Or C. Your obligation only begins after 120 days of non-payment. The answer is B. As a cosigner, you have equal legal responsibility for the entire remaining debt if the primary borrower fails to pay. And round 15. You receive a pre-approved personal loan offer in the mail that is valid to March 1st. You decide to apply for it on March 5th. How does the timing of your application affect the offer? A. The offer is automatically extended for another 30 days. B. The offer's interest rate is automatically increased by 1%. Or C. The offer's terms are no longer guaranteed. The answer is C. Financial offers have an expiration date, after which the lender is not bound by the previously stated terms. How did you do on these scenarios? Drop your score and thoughts below, and subscribe to see more challenges like this.